So where did we stop last time? So what did we do in the last class? There was another question we had to do. Monument Fair, September 2021, question 2, part A. So that's the last question that we did. Look on the dividend policy. Yeah. So we go back to the handout for the dividends. We go back to the handout for the dividends. So I had given you that handout for the dividends. So let us check some more details on the dividend policy. So in regard to that, I want us to go now to page. In the handout, we go now to page 6 about the dividend theories. We now go to the dividend theories on your page number 6. So on that particular page 6, they have stated that there are several theories which try to look at the relevance or irrelevance of the dividend payment. So we shall discuss some of these theories. So number 1, dividend irrelevance theory. Number 1 is meant to be dividend irrelevance theory. So for the dividend irrelevance theory, this theory was proposed by Franco, Modigliani, and Morton Miller in 1961, who argued that the value of the firm is determined by the basic earning power and the firm risk, and not by the distribution of the earnings. So the value of the firm, therefore, depends on the investment decisions, but not the dividend decisions, So their argument was, however, based on the following assumptions. Like number 1, they were able to say that there were no corporate or personal taxes. Number 2, no transaction costs associated with the share flotation. The market is perfect and frictionless. C, the firm's investment policy is independent of the dividend policy. Then D, the market is efficient and therefore investors and the managers have the same set of information regarding future investment opportunities. So that is now where we have as the assumptions. So that area was tested. When you go through the handout, that question was tested. So when you check through the handout, there was a question on that element in the sitting of April 2022, question 1, April 2022, question number 1, part B, April 2022, question number 1, part B, April 2022, question number 1, part B. So that question 1, part B, they say that state 5 arguments against Modigliani and Miller view that dividend policy is irrelevant as a means of affecting the shareholders' wealth. So I had said that assumptions are the same as weaknesses or limitations or disadvantages. So they are asking you to discuss argument against. They are simply asking you to give them either disadvantages, limitations, or weaknesses. So those are the same as the assumptions. Assumptions are the same as the weaknesses. So that number 1 in the handout, you are to break it into 2. You see, I've given you 4 of them. When you check in the handout, I've given, but number 1 is supposed to be separated into 2. No corporate taxes is a separate point. No personal taxes is also a separate point. So you are to distinguish it from that point. So that is now what happens. So you are to give them those assumptions. Argument against are the same as disadvantages or assumptions or simply the limitations. I hope that is clear. Yeah. So when they were asking me to give them arguments against are the same as limitations or assumptions or weaknesses. So the other question that was tested on that same item had also been tested. It had also been tested in the sitting of. So if you go to November 2018, there is a question number 1, part A. November 2018, there is a question number 1, part A. November 2018. So you go to page 40, you will see November 2018, question number 1, part A. November 2018, there is a question number 1, part A. So that question 1, part A, on page 40, they were asking me to examine 4 assumptions of Modigliani and Miller. 4 assumptions of the Modigliani and Miller dividend irrelevance. Those are the 4 assumptions that we have just seen up there. So that's now what I wanted you to go through to see how they normally test them. Those assumptions are the same as the argument. Then when you go back to the handout, kuna some information down there where they have said that they were able to prove that dividend is irrelevant in the determination of the value of the firm using the dividend yield model. So that part, proof on the dividend irrelevance. So I want us to use a question for you to understand that area more. I want us to use a question for you to understand that portion of the dividend irrelevance model. So there is a question in the sitting of, there is a question now in the sitting of May 2014, question number 3, part C. May 2014, there is a question number 3, part C. May 2014, there is a question number 3, part C. May 2014, question number 3, part C. So that question 3, part C, that question number 3, part C for the sitting of May 2014, question 3, part C. Question number 3, mine is on page 80. When you go to page 80, you'll see that question 3, part C. So the question reads that Baraka Limited has a cost of equity of 10%. Currently, the company has 250,000 shares. Currently, the company has 250,000 shares, which are quoted at the Securities Exchange, at shillings 120 per share, which are quoted at the Securities Exchange at shillings 120 per share. The company's earnings per share is 10 shillings, and it intends to maintain a dividend payout ratio of 50% at the current financial year. So they continue to say that the expected net income for the current year is 3 million, and available investment proposals are estimated to cost 6 million. So using Modigliani and Miller model, show that payment of dividends does not affect the value of the farm. We want to prove that whether you pay or you don't pay dividend, the value of the farm will just remain the same. That's the argument by M and M. That is meant to be the argument by M and M. So when we are approving that, we shall start off by, first of all, getting the value of the farm. We shall first get the value of the farm. So value of the farm should be equal to NPO. Value of the farm is equal to NPO, where N is the existing number of the ordinary shares. N is the existing number of the ordinary shares. And PO is the current market price per share. So going by that, we can get now the value for the farm. We can come up with the value for the farm. So N is the existing number of the ordinary shares. If you can check in the first paragraph, currently the company has how many shares? 250. So we take the 250,000 shares multiplied by the current market price per share. You can see the 120 per share. So multiplied by 120 per share. So when you take 250,000 multiplied by 120, it will give us how much? Give us 30 million. Okay. So online, are you getting 30 millions? Online, I hope you are getting 30 millions. Anyone who has computed those who are online? Let me see the figure you have calculated. Okay, so let us now confirm if no dividend is paid, whether the value remains the same. So we now want to confirm if no dividend is paid. If no dividend is paid. So if no dividend is paid, what should be the value for the farm? So if no dividend is paid, D1 is going to be equal to 0. no dividend is paid, D1 is going to be equal to 0. So maybe you can comment that where D1 is the dividend per share at the end of the year, where D1 is the dividend per share at the end of the year, where D1 is the dividend per share at the end of the year, where D1 is the dividend per share at the end of the year. So there are several steps which we shall follow to confirm that if no dividend is paid, the value still remains 30 million. So we start with the step number 1. Step 1, we shall say that estimate P1. Our first step is to estimate P1. First step is that estimate P1. So you also add there where P1 is the price per share at the end of the year. P1 is the price per share at the end of the year, where P1 is the price per share at the end of the year. So for us to get P1, I will be using this formula. I will use the formula that PO is supposed to be given by D1 plus P1 divided by 1 plus R. So PO will be equal to D1 plus P1 divided by 1 plus R. So far, we already know what is PO from what we have stated up there. D1 I've explained, also P1 I've just explained. So what is missing there is R, where R is the cost of equity, where R is the cost of equity, where R is now meant to be the cost of equity. So when it comes now to that point, our PO is what we had up there, the 120. So our PO is 120. So our D1, we have said if no dividend is paid, D1 should be what? 0. So our D1 is 0. Then we add P1 is what we are looking for. And 1 plus R. So R is that discounting rate or cost of equity. You can see in the first paragraph, the cost of equity is what percent? 10%. That is what is given as the start, where Baraka Limited has a cost of equity of 10%. So 10% is the same as 0.1. So make P1 to be the subject. Make P1 now to be the subject. We make P1 now to be the subject. We make P1 now to be the subject. So when you make P1 to be the subject, it should give you which figure? $122, $132. Online, you are getting which figure? Yeah, you just make P1 to be the subject. So if I make P1 to be the subject, because this one is at 0, so I just take this one and multiply by that. So that is the same as 120 multiplied by 1 plus 0.1 like that. So that's the same as 1.1 multiplied by 120. That's it is 132. Yeah. Yeah, it is 130. That's now our step number 1. We got the step number 2. We got the step number 2, where we say that estimate M. Our step number 2, we have it as estimate M. Our step number 2 will be that estimate M, where M are the number of the new shares to be issued. Where M are the number of the new shares to be issued. M are the number of the new shares to be issued to raise new capital. M are the number of the new shares to be issued to raise the new capital. So the formula I will use to get M, the formula is that M P1 should be equal to I minus X plus N P1 like that. So I'll also explain what each one of them stands for. So MP1 should be equal to I minus X plus N D1, where I, so you can start where I is investment opportunities. I is the investment opportunities. I is the investment opportunities. Then X is the net income. X is the net income. X is meant to be the net income. These others you already know. So we know our N from value. Yeah, we also know our D1 from here. So what we now do, we go to the last paragraph. Check in the last paragraph of the question. When you check through the last paragraph of the question, they had said that expected net income for the current year is how much? 3 million. And available investment proposals are estimated to cost how much? 6 million. So our investment is what is there as the 6 million. Our income is what is 3 million. Our income is what is meant to be 3 million. So this other one, we know N is 250,000. That's the same as 0.25 million. But we know D1 is what? 0. So, which means we end up getting a figure of 3 million. Because this one's at 0, and just subtract this from that. So we end up getting 3 million. But our interest is to get M. So M will be equal to MP1 divided by P1. So M would now be given by MP1 divided by P1. So MP1 is what we have gotten as the difference. And P1 you calculated to go to 132. P1 you go to 132. So normally we prefer to leave it like that. Because when you divide, so when you take 3 million divided by 130, it has so many decimal places. So when it has decimal points, you don't just leave it. Because you are simply confirming that whether you pay or you don't pay dividends, the value will remain the same. So that's now our step number 3. Sorry, number 2. You just leave it like that. Because if I take 3 million divided by 132, it must have a decimal point. But if I round off, the value may not remain the same. So now we go to the step number 3. We should now go to the step number 3. We now go to the step number 3. We now go to the step number 3. So step 3, I will simply be computing value of the farm. My step number 3 will simply be to get the value of the farm. So my step number 3 is simply value of farm. The step number 3 will simply be to get value of the farm. So under the value of the farm, we say that value of the farm. Value of the farm should be equal to Q1 in the brackets of N plus M. Then we subtract I, we add X, then we divide by 1 plus I. So now to get the value for the farm, I will be able to use those digits. So now value of the farm should be equal to P1 in the brackets of N plus M. Then we subtract I. We add X. We divide by 1 plus I. We divide by 1 plus I. So we already know P1. P1, 132. Yeah, so our P1 is 132. Then N, it is 250,000 shares. N is 250,000 shares. And then M, you take 3 millions divided by 132. 3 millions divided by 132. We subtract I. I is the investment. That investment is 6 millions. That investment is meant to be 6 million. Then X, it is 3 millions. 3 millions like that. So divide by 1 plus R. That is the same as 1 plus 0.1. 1 plus 0.1. So confirm that value. We are simply confirming that whether you pay or you don't pay dividend, the value will remain the same. Whether you pay or you don't pay dividends, the value should remain the same. So confirm and see what figure are we going to have at that point. So payment or non-payment of dividends. So confirm whether you are getting the same figure. You are getting the same 30 million. Yeah, so that will be the same value. So you are getting 30 millions. So whether you pay dividend or, so this one is when you don't pay dividend. When we are not paying dividend, the value is still coming to 30 million. So let us now confirm if dividend is paid, whether it will give you the same value. So we want now to check if dividend is paid, whether it will give you the same value. So this now, if dividend is paid, it is now if dividend is paid. We want now to confirm if dividend is paid, whether that value will still remain the same. So this is now if dividend is paid. If dividend is paid. Want now to check if dividend is paid. So if dividend is paid, dividend per share was not given, but we can calculate that. So dividend per share should be given by earning per share multiplied by dividend payout ratio. Dividend payout ratio. So if dividend is paid, to get the dividend per share, so I want you to check in the question in that first paragraph. So check in the question in that first paragraph where they were able to say that the company's earning per share is 10. Are you able to see the 10? And it intends to maintain a dividend payout ratio of 40%. 50%. So get 50% of 10. So get 50% of 10. We get 50% of 10. Just giving us 5. Yeah, so now we go back to the step number 1. We remember our step 1. We estimate P1. We start again with the step number 1, where we estimate P1. Where we estimate P1. So to get P1, you are using the formula that PO PO should be given by D1 plus P1. We divide by 1 plus R. So our PO, we know it was 120. Our PO, it was 120. So D1, we have said it is how much? It is 5. So you indicate here. So now D1, you can indicate that D1 is now 5. So you indicate up there that now D1 is 5. So we are looking for P1. You make it to be the subject. So 1 plus 0.1. So make P1 to be the subject. And see, it is giving us which value. We make P1 to be the subject and see, it is giving us which value. So when you make P1 to be the subject, it should give us which figure? Sorry? 127. Online, you are getting which figure? Those who are online, you are getting which value? Anyone who has calculated so far? Remember, you just take 1.1 multiplied by 120. Remember, it had given us which figure? 132. Then when you subtract the 5, because now it will cross, you minus. So they are saying it is 127. So that's now our step number 1. So that is now our P1 is 1. So let us go to the step number 2. We now go to the step number 2. So step 2, we said we estimate M. So the step number 2, we had said we estimate M. So to calculate M, I gave you a formula that MP1 should be equal to I minus X. Then we add P1 like that. So MP1 is supposed to be equal to I minus X. Then we add P1. So we already have the 6 millions. X was 3 millions. Then we add D1. So D1, we know it is 0.25 millions, but D1 is 5. D1 is 5. So let us get the value for MP1. $4.25 millions. So we are looking for M. So to get M, you get MP1 divided by P1. So to get M, you get MP1 divided by P1. So MP1 is 4.25 millions. Is 4.25 million. So divide by P1. So P1 is meant to be 127. So even that one, I said, you just leave it like that because probably it has some decimal points. When you divide, does it have so many decimal points? Yeah. So what we do, now we go to the step number 3. We go to the step number 3 where we get the value of the farm. We go to the step number 3 where we calculate the value of the farm. Go to the step number 3 where we should come up with value of the farm. So our step number 3, get the value of the farm. So step 3, get value of the farm. So value of the farm. So value of the farm. Value of the farm. It will be equal to. So remember, I say it is P1 in the brackets of n plus m. We subtract I, we add x, we divide by 1 plus r. So I, it was 127. Then n is supposed to be 250. So m is meant to be right by subtract So confirm whether it will give you 30 million. It is giving us 30 minutes. Yeah, so whether you pay or you don't pay dividend, the value will remain the same. So that those notes are given you. They will not make a lot of sense to you. But now if you follow this, you can see whether you pay or you don't pay dividend, the value is remaining the same. Online, I hope you have confirmed that. Is this figure giving us 30 million? Is it giving you 30 millions? Anyone who has computed that figure. So you can see whether you pay or you don't pay dividend, the value must remain the same. So you divide the question into 3. The first part, remember we got the value for the farm. So when you are repeating, if no dividend or if there is dividend, that value must remain the same. So you first of all take the number of the shares multiplied by the current market price per share. It will give you the value for the farm. Then you follow this procedure if no dividend is paid. You follow the same if dividend is paid. But the value will just remain the same. It will remain 30. So we can now make a conclusion by noting that. Therefore, payment or non-payment of dividends. Therefore, payment or non-payment of dividends. Payment or non-payment of dividends will not affect the value of the farm. Therefore, payment or non-payment of dividends will not affect the value of the farm. Payment or non-payment of the dividends will not affect the value for the farm. So that is now what we can be able to conclude on that item. That is now what we can be able to conclude on that question. So we go back to the handout. We go back now to the handout. We go back to the handout. When we go back to the handout, I still want you to check the question. The question for August 2022 in your past papers. Check August 2022. August 2022. There is a question number 3, part D. August 2022. It's a question number 3, part D. That question 3, part D, they were able to say that explain the following dividend theories. They would like you to explain the following dividend theories. So in your explanation, number one is the bird in hand theory. So if you check under those after the dividend irrelevance theory, go to number two. The theory number two is the bird in hand theory. Is the bird in hand theory, where they say that this theory was advanced by Gordon and John Lintner, who argued that a bird in hand is worthy two in the bush, and thus when the shareholder receives cash dividend, he is better off than one receiving the capital gain. So investors therefore value dividend more than capital gain. Remember, dividend is paid at the end of the year, but capital gain, you will get it when you sell the share. You may sell the share even after 5 years or 6 years. That's when you get. So capital gain is the profit you get when you sell the share. So we prefer to get dividend at the end of the year rather than staying for 6 years to get that capital gain. That's why they say a bird in hand is the dividend you have received. But two birds in the bush is what you will get for after a long time. So they now promise that you rather be paid dividend rather than the capital gain. That's now they mean by the bird in hand theory. So we prefer to be paid dividend rather than being paid what? The capital gain. So that's the argument by that bird in hand theory. So you just explain it in that manner. Then number two, you see the clientele effect theory. Number two is the clientele effect theory. That is the same as our theory number 5. Theory 5, they say the theory was proposed by Petit, who stated that different groups of shareholders have different preference for dividend. So, for example, low-income earners would prefer higher dividend to meet their consumption needs, while the high-income earners would prefer less dividend as to avoid payment of the tax. Therefore, when a firm sets up a certain dividend policy, there will be shifting of investors to it and out of it until equilibrium position is reached. At the equilibrium point, the dividend policy set by the firm will be consistent with the clientele it has. Therefore, dividend decision is an irrelevant decision, especially at equilibrium. So the explanation there is that we have two groups of people. Those who are earning higher salary or income and those who are earning low income. So we divide investors into two. So those who are earning higher income, they may not be interested in the dividend. But those who are earning low income, they want to be paid dividend to substitute their cost of living. So in that category, this theory, we cannot propose that we must pay dividend or we must not pay. It goes by the group of the shareholders that you have. Shareholders who are rich and they have a lot of income may not prefer to be paid what? Dividend. But those who are low income, they want to be paid dividend so that they can substitute that dividend for their cost of living. So we group it into two. So in that theory, we don't have a specific element. We simply look at the shareholders. Are they rich or poor? So poor, they must be paid dividends. But the rich, they don't want to be paid dividend. So that's now the clientele. Clientele is simply dividing people into two groups. So that is for the clientele. Then number 3. Number 3 is the same as your number 4 in the handout. Number 3 is the same as number 4 in your handout. You can see number 4, signaling theory. So signaling theory is that Stephen Ross in 1977 argued that in an efficient market, management can use dividend payment to signal important information to the market, which is only known to them. So if management increase the dividend, it signals expected high profit, and therefore share price will increase. Therefore, dividend decisions are relevant, and the firm that pays higher dividend will have a higher value, especially in the inefficient market. So that's now another theory, whereby any information in the company that goes out, it has a signal to the people in the market. whether the company is performing well or is performing poorly. So if a business is paying higher salary, that is obvious that company is performing well. So that's now what people normally look at. Then also when you look at the share price, if the share price of a given company share has gone up, it means that company is performing well. So any signal that comes from the organization, you have seen people who are working. When you see top managers resigning from a company going to look for jobs elsewhere, when you are down there, it says some information that probably there's a problem in terms of profitability or cash flows of the company. So then they have that knowledge. So that signal, if you see a top manager resigning, it gives you a signal that probably something is not right in the company. So that information, when it goes out, now people will react whether to continue. That's now what we mean by signaling theory. If you pay high dividend, it is simply telling people outside there that this company has a lot of profit. You can only pay dividend when there is enough profit. So it is a signal. But if you see a company is not paying dividend, it means it is struggling financially. So most of the people may not invest in that kind of the firm. That's now the information we get. So that's now the clientele theory. So apart from that, that question had also been tested in another sitting. So if you check May 2019, if you go to May 2019, if you go to May 2019, check question 1, part A. You go to page 35. And you check page 35. If you go to page 35, there is that question 1, part A, where they were asking you explain the following dividend theories. You see, number 1, information signaling theory. Number 2 is tax differential theory. Number 3 is the bird in hand theory. The last one is the agency theory. So all those theories are there in the handout. Agency theory is number 6. So get time, you read them. They normally ask some theory notes on that element. So I want us to have another brief subtopic. Another brief subtopic, we can have it as other models of the dividend policy. We look at other models of the dividend policy. Let us now look at other models of the dividend policy. We look at some other models of the dividend policy. We now look at other models of the dividend policy. We look at other models of the dividend policy. Other models of the dividend policy. So among the other models of the dividend policy, number 1, we have it as James Walter model. So among others, we start with number 1 as James Walter model. So these ones are not in the handout. I would like you to write them down. They are not in the handout. So we write something brief about James Walter model. So when it comes to that, we summarize that it is a model of the share valuation. It is a model of the share valuation. It is a model of share valuation which supports the view that the dividend policy of the company, will affect the dividend policy of the company, will affect the value of the share. The dividend policy of the company will affect the value of the share. It operates under the following assumptions. It operates under the following assumptions. It operates under the following assumptions. Number one is that the company is all equity financed. The company is all equity financed. The company is all equity financed. Then number two is that the company will only use retained earnings. The company will only use the retained earnings to finance its future investment. The company will only use retained earnings to finance its future investment. The company will only use the retained earnings to finance its future investment. Number three is that the rate of return on investment remains constant. The rate of return on the investment remains constant. The rate of return on the investment remains constant. Then number four is that the company will be existing until infinity. The company will be existing until infinity. So the company will be existing until infinity, i.e. it is a going concern. I.e. it is a going concern. It is a going concern. So if you can refer to the question for the sitting off. So if you can go to November 2020, question number 5, part B. November 2020, question 5, part B. So go to page 30. November 2020, there is a question number 5, part B. November 2020, there is a question number 5, part B. So that question 5, part B, they have said that Walter model on the dividend policy believes on the relevance concept of a dividend. According to this concept, dividend decision of the company affects its valuation. So required. So that Roman letter 2 should be Roman letter 1. Because it is being, so B, the information given, then required Roman letter 1, then also Roman letter 2. So discuss 4 assumptions of the Walters model. They would like you to discuss 4 assumptions of the Walters model. So those assumptions are what we have just listed. Those assumptions are simply what we have so far listed. That the company, number 1, the company is all equity financed. Number 2, the company will only use retained earnings to finance its future investment. Also, the rate of return on investment remain constant. The company will be existing until infinity. Those are the details you want to discuss. So remember, from that point, each one of them is giving you 2 marks on respect to that. So a new paragraph, we can write that based on these assumptions, comma, Walter came up with a model. Walter came up with a model of share valuation as follows. Walter came up with a model of the share valuation as follows. Walter came up with a model of the share valuation as follows. So Walter came up with a model of the share valuation as follows. So according to the James Walter, value our PO. So PO is supposed to be given by D, then plus in brackets E minus D and R over K. We also divide again by K. So I will explain what each one of them stands for. I'll be able to explain what each one of them stands for. So where PO is the current market price per share. PO is the current market price per share. Then D is the dividend per share. D is meant to be the dividend per share. Then E is the earnings per share. E is the earnings per share. Then R is meant to be the rate of return on investment. R is the rate of return on investment. Then K is the cost of capital. K is meant to be the cost of capital. K is meant to be the cost of capital. So going by that, we get now a question from the past papers. So go to the sitting of May 2017, question 2, part A. May 2017, question number 2, part A. May 2017, question number 2, part A. May 2017, question number 2, part A. So mine's on page 52, May 2017, question number 2, part A. May 2017, question 2, part A. So that question reads that the following information was extracted from the financial statement of Mwaka Limited. Earning per share is 15. Capitalization rate is the cost of capital. Capitalization rate is what they are referring to as the cost of capital. It is 12%. So retention ratio, it is 40%. Then internal rate of return, they have given you 16%. So required. The price per share, we are only checking the Roman letter 2. We have not done the Cordon model. So we are only checking the Roman letter 2, Walter's model. So when we use the Walter model, I've given the formula how to get the price of the share. So what we need to do now is to calculate it, because earning per share is given. The rest of the detail has been provided. So what you need to come up with is to get dividend per share. So dividend per share, remember we said it is given by earning per share multiplied by dividend payout ratio. Dividend payout ratio. So earning per share was given. Earning per share was given. Are you able to see the earning per share? You are able to give you 15. And are you able to see the retention ratio? So if they retain 40%, they pay out what percent? 60%. So dividend payout ratio will be 60% because the retention ratio is 40%. So get 60%. So it will be and we have seen that. So that is now our D. D is 9, E is 15. That is the annual partial. Our E is the annual partial, which is 15. And D is the dividend partial. And R is given. R is the internal rate of return, which is 16%. So K is the cost of capital, which is the same as the capitalization rate, which the question has given us 12%. So that 12%, the capitalization rate is what is the same as our cost of capital. So now we go to our model. You want to get PO. So D, it is 9. We have just calculated. E, it is 15, also minus 9. So R is 16%, which is the same as 0.16. K is 12%, which is the same as 0.12. We also divide again by 0.12. So get now the value of that share according to now the James Walter model. So giving around this here. 125. 141.67. Online, I suspect we should also be getting the same. 141.67. Anyone to confirm that? That is what I've been given from the physical class. Online, you are coming up with which value? Yeah, they are getting the same thing. So that was about the James Walter model. So Roman letter 1, I'm not going to do it because it is on a different topic, the Gordon model. So we go to another model, number 2. Remember number 1, we said James Walter model. So we go now to number 2. We now go to number 2. We now go to number 2. So number 2 will be model. So number 2 will be now model of the dividends. Now model of the dividends. So under that, we summarize that it is a dividend policy model. It is a dividend policy model where dividends to be paid, takes into account, where dividends to be paid takes into account, where dividends to be paid takes into account the current dividends. It takes into account the current dividends, comma, adjustment rate or factor, adjustment rate or factor, adjustment rate or factor, and the previous period dividends, and the previous period dividends, and the previous period dividends. Therefore, according to this model, dividend per share, dividend per share will be expressed as follows. Dividend per share will be expressed as follows. Dividend per share will be expressed as follows. So if you want to compute the dividend paid, so dividend per share should be paid. Dividend per share should be paid. Dividend per share to be paid. You simply take current dividend per share, multiplied by adjustment factor, multiplied by the adjustment factor of rent. Then we shall be required to add. Previous period dividend per share. That's dividend per share. But in brackets again, 1 minus adjustment rate. 1 minus the adjustment rate. So you simply take dividend per share to be paid. You get the current dividend per share multiplied by the adjustment rate. Then you add in brackets previous period dividend per share multiplied by 1 minus the adjustment rate before you combine them. So there is a question for May 2016. May 2016, question number 2, part B. So go to May 2016. There is a question number 2, part B. May 2016. There is a question number 2, part B. 2016. Question number 2, part B. We go to page 62. You will see that question number 2, part B. You'll be able to see that question number 2, part B. So that question 2, part B, the question reads that the following information relates to the dividend per share for Somolo Limited. So the questioner had given you earning per share for the year 2016. Also dividend per share for year 2015. Then target payout ratio. Then adjustment rate. So required using the Lindner model, predict the dividend per share for the year ended 31st December 2016. They would like you to predict the dividend per share for the year ended 31st December 2016. So what we are lacking is this current dividend per share. So from the previous question, you have seen that to get the dividend per share, get the earnings per share multiplied by dividend payout ratio. Dividend payout ratio. So from the previous question that we have done, when you want to get the dividend per share, so this one will be the current dividend per share. So this one, I want to get the current dividend per share. So it will also be given by the current It is the current earning per share. So to get the current dividend per share, simply take the current earning per share multiplied by dividend payout ratio. So are you able to see the year 2016? That's now the current. How much was the earning per share? They were able to give you 6. So dividend payout ratio is the target payout ratio. Are you able to see the target payout ratio? 0.6. So when you multiply by 0.6, what should be our current dividend per share? It should give you 3.6. So that is now what we use to go back to get our dividend per share to be paid. So dividend per share to be paid. Dividend per share to be paid. So current dividend per share is what you have just calculated, because the question was asking for the year 2016. That's why what we have calculated, anything for 2016 is the current. So that figure is 3.6. It's meant to be 3.6 like that. Then adjustment rate was given. Are you able to see 0.7? So they have 0.7. Then previous period dividend per share is what was paid in the year 2015. You see, 2015 it was 2 points. So multiplied by 1 minus 0.7. So that should give you dividend per share to be paid. It should be able to give you the dividend per share to be paid. So it has given you each figure. 3.2. 3.24. So at your own free time, you can attempt the one for December 2013. December 2013, question number 4, part A. At your own free time, attempt December 2013, question 4, part A. So now I want us, so that's the conclusion for the dividend policy. So now you read the theory. That's now the conclusion for the dividend policy. The computation part, I have handled all of those areas. So what you do now, you read the theory part. That now concludes that topic for the dividend policy. So now our next topic will be financial forecasting. Our next topic should now be, the one for the financial forecasting. Financial forecasting. The next one should now be financial forecasting. Financial forecasting. So when it comes to financial forecasting, we are just projecting the cash flows we expect. So before we do anything, we can introduce by writing that. This involves the projection of the future financial requirements. Projection of the future financial requirements of the company. Projection of the future financial requirements of the company. Projection of the future financial requirements of the company. Then we continue by writing that it is important due to the following reasons. It is important due to the following reasons. It is important due to the following reasons. Number one is that it forces managers to plan early in advance. It forces managers to plan early in advance. It forces managers to plan early in advance. It forces the managers to plan early in advance and allocate the resources efficiently. It forced the managers to plan early in advance and allocate the resources efficiently. And to allocate the resources efficiently. That's now number one. Number two is that it forced the management to avoid surprise. It forced the management to avoid surprise. It forced the management to avoid the surprise, which might occur in the course of the operations. It forced the management to avoid the surprise, which might occur in the course of the operations, i.e., if there is a deficit, managers would decide in advance. If there is a deficit, managers will decide in advance on how to finance the deficit. If there is a deficit, managers will decide in advance how to finance the deficit. The next one is that it is used for the control purpose. It is used for the control purpose. i.e., to enhance control of the expenses. And to avoid wastage during the operations of the company. The number four is that it is used for the motivation purpose. So that is now about the importance of financial forecasting. So when you do financial forecasting, those will be the benefit you derive. So you can now look at methods of financial forecasting. We now look at the methods of financial forecasting. So there are two of them. Number one would be percentage of the sales method. Number one would be the percentage of the sales method. Number two would be the cash budget. So number two would be cash budget. So there are two of them, which we normally use to project the future financial requirement. So we can start with the percentage of sales method. We can start off with the one for the percentage of sales method. Start the one with the percentage of sales method. Start the one for the percentage of sales method. The percentage of the sales method. So we can summarize that under this method, the following steps will be adopted. Under this method, the following steps will be adopted. Number one should be that identify. So the step number one is that identify the balance sheet items. Which will change as the sales change. identify the balance sheet items which will change when the sales change. Identify the balance sheet items which will change when the sales change. When the sales change, i.e., they include current assets and current liabilities. They include current assets and the current liabilities. They include the current assets and the current liabilities, comma, fixed assets, comma, retained earnings. So those are the four items: current assets, current liability, fixed assets, and the retained earnings. Then a continuation on the same, we write that long-term debts and ordinary share capital, long-term debts and the ordinary share capital, long-term debts and the ordinary share capital will not change when the sales change. Long-term debts and the ordinary share capital will not change when the sales change. Not change when the sales change. Since this capital is acquired, to finance. This capital is acquired to finance long-term projects. It is acquired to finance the long-term projects. It is acquired to finance the long-term project. And it is not for the revenue expenditure. And it is not for the revenue expenditure. And it is not for the revenue expenditure. So that's now the note I wanted you to have, whereby we say that long-term debt or ordinary share capital, those items, they don't change. Here we are only looking for the items which change when the sales change. So don't include their long-term debt and ordinary shares. Those are not for the revenue expenditure. We acquire them in order to finance the long-term project. So those ones, they don't change. So when you are identifying the items that will change when the sales change, don't include ordinary share capital and long-term debt. But the other four, you include them. Number two is that the step number two. The step number two will be that express the various balance sheet items. Express the various balance sheet items. Express the various balance sheet items which will change when the sales change. Express the various balance sheet items which will change when the sales change. Which will change when the sales change as a percentage of the sales. As a percentage of the sales. As a percentage of sales. So what we are simply explaining there is that all those items you have listed, express them as a percentage of sales. Take that figure, divide by the sales, then express it as a percentage. That's now our step number two, where we are saying that we express all those balance sheet items that will change when the sales change as a percentage of what? The sales. So the figure you get like now for the current liability, divide by the total of sales, then show it as a percentage. That will be our step number two. Then step number three is that determine the total financial requirements. Determine the total financial requirements. Determine the total financial requirements. During the forecasting period, determine the total financial requirements during the forecasting period. During the forecasting period, due to the increase in the sales, determine the total financial requirements during the forecasting period. During the forecasting period, due to the increase in the sales. Due to the increase in the sales. Due to the increase in the sales. Then finally, the step number 4 is that compute the external financial requirements of the company. Compute the external financial requirements of the company. Compute the external financial requirements of the company during the financial period. During the financial period as follows. So compute external financial requirement of the company during the financial period as follows. So this now how to get the external financial requirement. It's how we should be able to come up with the external financial requirement. So to get our external financial requirements, so to calculate our external financial requirements. So external financial requirements. So to get the external financial requirements, we start off with increase in the fixed assets. Increase in the fixed assets. To start off with the increase in the fixed assets, then we add increase in the current assets. We add increase in the current assets. And you add the increase in the current assets, we get the total financial requirements. We get the total financial requirements. Now you less increase in current liabilities. Retained earnings. We are subtracting these two. Subtract those two, so now we get the external financial requirements. External. So that is now the format we shall be using as our step number 4. So before we conclude, we can also add there a paragraph by noting that the following are the assumptions. The following are the assumptions or weaknesses or limitations. Assumptions or weaknesses or limitations of the percentage of the sales method. The following are the assumptions or weaknesses or limitations of the percentage of the sales method or the percentage of the sales method. Number one is that the company is operating at full capacity. The company is operating at full capacity. The company is operating at full capacity. Therefore, Therefore, the increase in the cells, therefore the increase in the cells, the increase in the cells will lead to, the increase in the cells will lead to increase in the fixed assets. Increase in the cells will lead to increase in the fixed assets. It will lead to the increase in the fixed assets. Number two is that it ignores inflation in the economy. It ignores inflation in the economy. It ignores inflation in the economy. Number three is that the concept of the time value of money, the concept of the time value of money, i.e., the time value of money does not change, i.e., the time value of money does not change. The time value of money does not change during the period under the analysis. The time value of money does not change during the period under the analysis. It does not change during the period under the analysis. The next one is that number four. The relationship between the balance sheet items, the relationship between the balance sheet items and the cells, the relationship between the balance sheet items and the cells will remain constant, during the period under analysis. It will remain constant during the period under analysis. It will remain constant during the period under analysis. Then number five is that the corporate tax rate will not change. The corporate tax rate will not change during the period under analysis. The corporate tax rate will not change during the period under analysis. The corporate tax rate will not change during the period under analysis. So there is a question they had tested you on that. So there is a question on that part. In the sitting of August 2022, when you go to question number three, part A, August 2022, question number 3, part A. They have asked you to examine 4 shortcomings of the percentage of the sales method of forecasting. So the shortcomings are the same as the assumptions. They are the same as the limitations. They are the same as what? The weaknesses. So those are now the points they wanted you to give them. So you are supposed to give them 4 of them. So, given the fact that they have not been testing that topic, the last time I suspect they tested was around 2016. Now, last sitting, they tested a small theory. So, likely this sitting, now they tested the comprehensive question. That's normally what they do. When you see them coming up with a small theory question for the previous sitting, then in the current sitting, most likely they will come up with a question on that. So when we meet now, we shall check a question from the past papers. We shall start with the one for November 2011. November 2011. We shall do the one for November 2011. Question number 4, part A. November 2011, question number 4, part A. So when we meet now in our next class, that is what we shall start on with. That is what we shall start on with. So we can stop there. Maybe so there are 2 of them. Another one is November 2016. November 2016, question 3, part A. November 2016, question 3, part A. So we shall pick one of them, we do them in that order. So we stop there for today. So when we meet in our next class, which should be tomorrow, God willing, we shall now check another question on those 2 questions. So let us stop there for today. Stop there for today.